Thank you for joining us for this webinar. My name is Shane Johnston. I'm a managing partner at Blue Summit Wealth Management, where for over 20 years we've focused on sustainable and responsible investments, also known as SRI, as a way to help individuals and organizations align their money with their values. I'm joined today by Amber Fairbanks, a portfolio manager with Zevin Asset Management. Founded by Robert Zevin, PhD Harvard Economist and SRI pioneer, Zevin Asset Management is a tactical manager who takes a defensive approach to managing money. In light of the government shutdown, the looming debt ceiling, rising interest rates, and inflated stock market, and all of the risks currently taking place in the market, Amber is going to discuss the various scenario models that they're employing in an effort to mitigate potential losses during this uncertain time. To get us started here, let's talk for a moment about the government shutdown that's currently underway. The shutdown started the Tuesday before last after Congress sent a couple spending bills to the Senate that attempted to defund the health care legislation. But the Senate rejected their proposals, taking out the health care defunding measures, and sent the clean resolutions back to the House, which, if you can elaborate here, Amber.
Which did not get passed in time for the 9:30 deadline, hence the shutdown. So prior to this, there have been 17 government shutdowns, and therefore the government has implemented laws to ensure the shutdown isn't catastrophic to the economy. And these include provisions allowing for essential government functions to continue. And I have essential there in quotes. What is considered essential is slightly open to interpretation, but this includes employees whose jobs relate to the protection of life and property or continuation of payments under entitlement programs such as Social Security and Medicaid. So then on the next slide, what exactly is the impact of this shutdown? So there have been a lot of economists, and Goldman Sachs among them, who have estimated that there's a 0.2% annualized direct impact on fourth quarter GDP per week of the shutdown. Half of this impact comes from lower government spending, and the other half is from lower consumption and investment. There's also an indirect impact, which isn't as quantifiable. There's been a lot of talk of private sector layoffs. Boeing and United Technologies both depend heavily on the government. They've already talked about furloughs if the shutdown continues. There's also an impact to consumer and business confidence. So the impact from consumer and business confidence is all less quantifiable. Clearly, the longer the shutdown lasts, the larger the indirect impact. So a lot of this negative GDP impact in the fourth quarter should be recovered as employees receive back wages from the furloughs and confidence improves. But the immediate impact, at least initially, is that 800,000 furloughed workers are without pay. All non-essential programs are closed. In terms of what the stock market did, originally it pretty much shrugged off the shutdown. And some commentators even said it was positive in that if they could resolve the shutdown before the debt ceiling debate, it would be unlikely that we would see such a contentious debt ceiling debate. But as it drags on and both sides seem no closer to a resolution and the debt ceiling looms, investors are understandably getting nervous. I'll talk a little bit about what's going on today a little bit later in the presentation because obviously this is a changing situation. But if we could just switch from the shutdown to the debt ceiling for a minute, which I think is a bigger concern for investors. The Treasury has said that it reaches the maximum amount it's allowed to borrow under the current debt limit by October 17th, and therefore won't be able to have the funds to pay the government's bills after this date. The Treasury lacks the legal authority to borrow more and to fund the difference between spending and tax revenue unless the debt ceiling is raised. This timeline of October 17th has changed slightly, but we're certainly looking at a late October deadline by which the government is going to run out of money if the current debt ceiling is not extended. So when I put together these slides about a week ago, it seemed extremely unlikely the government would not raise the debt ceiling given the catastrophic potential fallout from that. But the probability grows higher as time passes without a resolution. And a bit ominously, Republicans are beginning to talk about how the U.S. won't default if a debt ceiling is not immediately raised. So there have been news about the short-term potential raising of the debt ceiling, which would essentially push it back 6 weeks, allow the debt ceiling to be raised for 6 weeks. But obviously that's just little more than kick the can further down the road. So what happens if the debt ceiling is not raised? There are 3 potential outcomes. The first is that Obama evokes the 14th Amendment, which states, in brief, the validity of public debt of the U.S. shall not be questioned. But there are questions about the legality of evoking this. And realistically, investors are going to demand a higher yield on new bonds issued that may later be ruled to be illegally issued by the Supreme Court. The second option is that the Treasury pays some bills, but not all, meaning it pays interest and principal on debt, for example, but not Social Security or Medicare, which means no technical default. But the Treasury Department has already said it lacks the logistical capabilities to do so, and it becomes a question of fairness. You pay interest and principal on debt, but not pay someone their Social Security payments. So the third option is to pay no bills, which means default on some of the debt issues. Obviously, none of these are good solutions, but what does it all mean from an investing perspective? So we think, or at least hope, that the government understands the dire implications of failure to raise the debt ceiling, and we have not modeled a specific scenario in our forecast in which the government fails to do so. If the shutdown is short, meaning less than 3 to 4 weeks, and the debt ceiling is resolved before the end of October when the Treasury runs out of money, the economic impact should be minimal. The stock market will go down prior to the resolution and recover after and into the end of the year, we expect. If the shutdown is longer than a few weeks and the debt ceiling is not resolved before the end of October, it's difficult to say exactly what would happen, as has never happened before. But as we know, the market hates uncertainty, and clearly stocks globally go down. It would make sense for bond prices to go down as well and yields to go up, since this is a default situation and investors would demand higher return to compensate for risk of owning debt that may or may not be paid back. However, it's possible that bond prices rise, as there's no question over the U.S. government's ability to pay, just their willingness to do so in a timely manner. It's extremely likely that interest payments are paid just late after the ceiling is raised. So what happens to bonds remains a question mark, but it would certainly be a risk-off event for stocks, hurting cyclical and high-beta stocks hardest, as well as emerging markets. So I want to just turn briefly to 2 other concerns that we are looking at Zevin Asset Management. The first is stock market valuations. So U.S. stocks have had a very strong run over the past 2 years. And if you look at them from a cyclically adjusted price-earnings ratio, which is equal to the 10-year average of inflation-adjusted earnings as a denominator and the current stock market as the numerator, it's currently at 24 times. So the average of this ratio over the past several decades has been 16.5 times. And the last time it was this high was right before the market crashed in 2008. It's not always the best indicator of future market performance, but it's certainly not a number we're ignoring. However, if you look at the last 2 years, what we've seen has been slow economic growth, which has led to low inflation and low interest yields, and slowly improving unemployment. From a company standpoint, this is actually a beneficial environment for profit growth, as there's no wage or input cost pressures. In our most likely scenario, we expect this low growth, low inflation environment to continue, which should continue to benefit stocks, particularly in the U.S. So looking ahead 12 months, we are seeing mid-single-digit global market expected returns on our analysis, with higher returns in the U.S. and Japan. And bonds, while offering protection in any reemergence of the European debt crisis or increased emerging market risks, have unattractive returns in our more positive and more likely economic scenarios. Turning quickly to Europe and the sovereign debt default concerns, we think they are still an issue, although no longer daily headlines. Eurozone has been helped in large part by an improving economy and by the European Central Bank policy. However, we think long-term structural concerns have yet to be resolved and continue to believe that although another debt crisis is unlikely in the next 12 months, austerity in the region will continue to put downward pressure on economic growth. And then turning to emerging markets in China, the country is moving from an export-oriented to consumption-oriented growth, and any transition like this introduces risks. We've already seen growth slow dramatically, and we have concerns that it might slow further. In terms of our portfolio positioning, we're currently overweight in the United States and Japan relative to the MSCI All-Country World Index. We have 2% in long-term U.S. bonds. It's a position that we've significantly reduced since the beginning of the year, but it's an asset class that offers the best form of protection in our more negative scenarios. So we're closely monitoring what's going on in the U.S. government and other global concerns. I don't want to minimize the impact of what the current government is doing on the stock market and on the economy. But we're not market timers, so we're not looking to get out of stocks, say, 2 weeks before the government has a resolution and get back in when the resolution occurs, for example. But if we think that an event has lasting implications, we will certainly look to protect our client portfolios. So that's all that I have in terms of prepared remarks. I'd be happy to take questions.
Great. Amber, I've got a question just right out of the gate here, maybe a two-part question just to help clarify a couple of the points that you covered. So just by way of background on how you guys are actually modeling these different scenarios, and I took note of 4 different risks that you guys are paying attention to right now, one being the current risk we're in, which is the government shutdown, the debt ceiling, overvaluation in stocks, and then Europe and emerging markets. So those are 4 different scenarios or risks that you guys are modeling out. If you could just talk for a second about what your guys' process is, how you guys assign probability of different scenarios, et cetera. And then secondarily, if you can clarify of those 4 risks, which ones are you guys actually mainly concerned about, or if you could just prioritize them, say the biggest risk down to the smallest risk.
Sure. So our process is basically to look at the world around us and what we see unfolding over the next 12 months. And we break that into different scenarios. And so we have a number of macroeconomic variables that get filtered in, and, what's GDP going to do in each of these scenarios? What's inflation going to look like? What's currency going to look like? All sorts of macroeconomic variables that get filtered into these scenarios. And we have a matrix of all of the different regions and the sectors within that region. So once we've done that, we end up with a large matrix which has expected values based on the probabilities we put on each of the scenarios. Currently, we have about 5 scenarios. And from there, we go to make a portfolio for clients that, first protects clients on the downside risk and then participates in our better scenarios. So in terms of assigning probabilities, it's something we talk about in our investment committee meetings. We meet twice a week, and there are 6 people on our investment committee team. So we talk a lot about, what is the right probability. It's quite subjective. We look at, what's occurring now, what's happened in history, but it ends up being a fairly subjective probability. In terms of prioritizing the risks that we talked about today, right now we're not seeing the government shutdown or the debt ceiling to be a huge long-term risk. Again, our investing timeline for our scenario forecast model is 12 months. So for something to have an effect in the portfolio construction, it would have to have a lasting impact, meaning more than just a couple weeks. I think that, in terms of prioritizing, I'd say that both Europe and some of the country-specific risks in emerging markets are our top priorities in terms of what we're protecting clients against. Stock market valuations, as I said, valuations look somewhat high on a cyclically adjusted basis, but we are expecting in our most probable scenarios that the type of environment that has benefited stocks the past 2 years continues to benefit. So the U.S., for example, looks far more attractive to us currently than Europe and emerging markets.
Well, I don't know if anybody else feels whether this is helpful in light of a lot of the media noise that we've had over the last couple of weeks with what's going on in Congress. And whether it's reassuring to know that you guys aren't putting a high probability that this will have a long-term impact on the market. I think it not just Zevin, but as we look around at other money managers and just the overall market, today the market is up, and I think that's a reaction to the signals basically coming out of Congress being that there's going to be some kind of negotiating. But before that, there wasn't a large downturn in the market. When as we got closer to the government shutdown and then continue to get closer to the debt ceiling, I think a lot of people have been surprised that there hasn't been more of a downward reaction in the marketplace. So I think those things, to me, reaffirm what you guys are talking about in your internal meetings as far as not putting a high probability that the government would actually let us default and not raise the debt ceiling. So hopefully that's reassuring to folks that this too shall pass, and that probably a lot of this is more political posturing than anything else.
Right.
All right. Well, very good. Thanks, everybody, for joining. Thank you again, Amber, for your presentation and for your remarks. Appreciate your time. And
sure.
If anybody has any future questions that maybe they didn't think of at the moment, you can feel free to give us a call here or send an email, and we can relay them on to Amber if we can't answer them ourselves.
Great. Thank you, Shane.
Okay. Have a great day, everybody.